In this video, series 17, let us understand the financial statement of a business enterprise. Financial statements contain the information of a business enterprise prepared in a structured manner in a form easy to understand. The financial statements include 1. Balance sheet of a firm, 2. Profit and loss account statement of a firm, 3. Cash flow statement for the financial year. A business enterprise may approach a bank either to open a current account or for seeking a credit facility. In both the cases, the banker has to take a decision whether to accept the business enterprise for a banking relationship. The financial statements play a very vital role in taking a decision either to accept the business as a customer or the business for the purpose of lending. The financial information gives lot of information on the financial health of a business. Today, let us understand each of these statements. I have told you that the documents contain balance sheet of a firm, profit and loss account statement of a firm, and the cash flow statements for the financial year. As a banker, the cash flow statements are not of much relevance, so our discussions will be restricted to the balance sheet and a profit and loss account. Today, we are not going to discuss the financial statements of a large corporate. For the large corporate or a company whose shares are traded in the stock exchanges, there are various statutes based on which these companies have to prepare financial statements. They are ICAI, SEBI, CBDT, RBI, Company Law Board, etc. Our aim is to understand a simple balance sheet and a profit and loss account today. The users of these financial statements are the lenders like banks, the creditors who supply material to the business enterprise, the debtors who buys goods from these business enterprises, the tax authorities who collect income tax, GST, etc. from the business, the investors who would like to invest in the shares of companies, etc. Today, what we are going to discuss is a simple balance sheet. A balance sheet is prepared as on a date, generally as on 31st of March every year. The balance sheet has got two parts. One is equity and liabilities and the other is assets. Equity and liabilities are liabilities for the business, which means that they are the sources of funds from where the business gets the money. Assets are owned by the company. The assets are created out of the funds which have come by way of equities and liabilities. Equities and liabilities indicate what the firm owes. Assets are those which the firm owns. Assets indicate the application or uses of funds. The total amount of equity and liabilities should match with the total amount of assets. Now, under the liability, there are two things. One is equity and the second is liabilities. Equity means the owner's fund in a business. Suppose somebody wants to start a business enterprises, he wants to invest 10 lakhs in the business. This is known as the owner's fund in the business. Owner's fund in the business is classified as capital in the business. There is a business accounting concept which says the owner is different and the business enterprise is different. The owner has given 10 lakh rupees to the business enterprise to do business. Tomorrow, when the business is closed or wound up, the business has to return the 10 lakhs to the owner. That is the reason why the capital in a business appear under liability side as equity. Now, there are two other terms which we need to understand under equity. They are surplus and reserves. Suppose somebody has set up a business enterprise with a capital of rupees 10 lakhs on 1/4/2019. During the period from 1/4/2019 to 31st of March 2020, the business made a profit of 3 lakhs. The owner is not withdrawing any amount from the profit. Now, when the firm draws the balance sheet as on 31/3/2020, 10 lakhs will appear as capital and the 3 lakhs will appear as surplus. This means that surplus is the profit generated and retained in the immediately preceding year. Now let us understand what is meant by reserve. Let us continue the same example. During the period 1/4/2020 to 31/3/2021, the business enterprise generates a profit of 4 lakhs. Similarly, the owner does not withdraw any profit from the business. In this case, when the firm draws its balance sheet as on 31/3/2021, the capital will be rupees 10 lakhs and the surplus of the year before last 3 lakhs will be recorded as a reserve, and the 4 lakh, the profit which is generated and retained in the immediately preceding year, will appear as surplus. Now the balance sheet will show a capital of 10 lakhs, a reserve of 3 lakhs and a surplus of 4 lakhs, totaling to 17 lakhs. So this rupees 17 lakhs is a liability to be paid by the firm to the owner when the business is closed. Liability means anything which is payable. Now, the financial statements help the bank in understanding what is the amount of capital invested, whether the business is generating profit, whether the profit is retained in the business, to what extent is the borrowing from others, whether the company has got sufficient profit to repay the loan. All these things a banker comes to know by analyzing the financial statements. In the next video, we shall go further into the items of liabilities in a balance sheet. In case you have understood this, please press the like button and subscribe to this channel. We will be continuing our discussion in the next video. Thank you very much.